Day 6, how to analyze stocks using fundamental analysis. What's up? It's your boy Zay. Welcome back to the BMA Black Market Academy, man. We're about to be looking at how to analyze these stocks. We looked at technical a lot in these last couple of days, but today we're going to be looking at fundamental. What is fundamental analysis? Fundamental analysis involves evaluating a company's financial health. So, how good is their finances? Their industry position. So, are they dominant in their industry? Is Apple better than Boost? Yeah, they are. So, they're dominant in their industry. And market conditions. Is the market up? Is it bullish? Is the market down? Is it bearish? To determine its intrinsic value. So, if the company market cap, let's say, is 600 million, but we feel that intrinsically, like the actual fundamentals of the company is worth 1 billion, then we know the company is 400 million undervalued. So that would be a good investment. Then we look to sell off at, its intrinsic value, which would be 1 billion. So the stock goal is to identify undervalued or overvalued stocks by examining financial statements, economic factors, and company performance. This method contrasts with technical analysis, which focuses on price movements and charts. Right? So usually technical analysis, like I said, is the effect of fundamental analysis. That's how I like to look at it. So fundamental analysis is the cause, and technical analysis is the effect of what's going on within that company. So that's pretty much how we look at that. Key financial statements to review. Okay, the income statement shows the company's revenue, expenses, and profit over a specific key metric to focus on. Revenue growth is sign of the company's ability to increase sales, and net income, which is profit, indicates whether the company is making money after all expenses. Now, y'all know me, and y'all know I gotta pull up these charts, or these statements. All right, income statement, right? So we talked about first revenue growth. So we look at the revenue. Revenue is the entire money that business made. So we're looking at Apple. Gotta look at Apple. You know what I'm saying? So this is in thousands. So 391 billion. If I'm not mistaken, that's 300. Let's just do it. Let's do it. Let's do it. I know I'm right, but I gotta show y'all that I'm right. You know what I'm saying? 391, comma, blah blah blah, comma blah blah blah, times. Times 1,000. That should be 391 billion. 0, 0, 0, 0, 0, 0. That's 391 billion. Okay, if I'm not mistaken, that's insane. That's insane. Jesus Christ, bro. That is insane. What the? Jesus. Okay. All right. That's crazy. That's annually. Okay, I'm like, dang, they're making that quarterly. No, it's annually. Okay, so every year they're making about 391 billion. I was like, they're making that quarterly? What the? Like, that's what? Okay, yeah, but they're making that annually. I was going insane. That's why I got so quiet just now. I was like, whoa. All right. So every year, so in 2021 they made $365 billion. In 2022 they made $394 billion. In 2023 they made 383. So overall they're increasing. They went in the last 4 years they went from 365 to now at this very time I'm recording 391. So as you can see, that company is growing. Gross profit 152 in million to about 180,000. So we know that company is growing, right? The company is growing. Revenue, people be like, all right, usually when you see people online, they be like, we made $1 million. Now, their company might have made $1 million in total revenue, but their profit isn't that. So even though their company made $1 million, after they paid staff, did marketing and all that, they might only profit, $10 million, right? So that's the profit that actually goes back to the business, and then, the owner starts taking his shares and whatever else the case is. So that's the difference between revenue and profit. Revenue is everything the business made, and profit is what do we keep after we paid everything off. The balance sheet shows the debt to equity ratio, the current ratio, and the cash flow. And we got the cash flow statement too. Debt to equity ratio helps assess financial leverage and risk. So we go to the balance sheet really quickly. We look to the debt to equity ratio, and I don't see him. Well, that just shows you the debt to equity. So what is the debt of the company compared to the equity? You want that to be positive. So you want to have more equity than debt, and that you're in a good position. So basically, if the company was to liquidate, you would be in a good position rather than a bad position. as far as would you get money or not. Especially when we're talking about the preferred stockholders versus the common stockholders. And the current ratio measures the company's ability to cover short-term liabilities with its short-term assets. So, with the current ratio, if we have, I'm pretty sure the current ratio is in here, huh? Or is it in statistics? Yeah, it is. All right, so basically 0.87. So this means with our short-term assets, so if my short-term liabilities, so like within the next year, if I have to pay $1 million in debt, but I only have $87 million worth of assets, then my current ratio would be 0.87, as y'all can see. But if I have $1 million worth of debt and I have $1 million worth of assets, then my current ratio would be 1 on the dot. So as we can see, their current ratio is a little lower, so we actually have a little bit less assets than debt. But of course, they can pull from cash anywhere else to pay that debt. So that's important to look at the whole financial statement of the entire company. Cash flow statement tracks the company's inflow and outflow of cash. Positive cash flow is crucial for sustaining operations and growth. All right. A lot of companies don't have positive cash flow, so I'm about to show you this right now because this is really important. This is super important. Go back to financials. We're going to come over to cash flow. Sorry, free cash flow. 92 million, 111 million, 99 million, 108 million. So we see from 92 to 108, we have more cash coming to Apple every year. Now let's look at another company. Let's look at y'all, Nike. Just do it. Just do what? What are Nike just doing? Let's see what they just doing. Let's see. Nike, 5 million, 4.4 million, 4.8. So they stand steady. So we're not gonna bully Nike. They stand steady with their free cash flow, but they're not growing like Apple's is. They pretty much stand the same. They're pretty much consolidating with their free cash flow. What company can I pick on, man? What's a company I could pick on? What is a company I can pick on? I don't know. I can't think of it on the top of my head. I can't think of a company on the top of my head. Let's see. P 500. Let's see. Oh my God, where am I? I'm all over the place. Holdings. I can't think of no company right now on top of my head. No. Oh, there we go. All right. Okay, now let's go to only show me top 10. All right, well, let's look at another company. All these companies are good, so all these companies will have positive cash flow for the most part. I don't know, Tesla. I don't know. Does Tesla have? Let's look at Tesla. Now we're going to go to the next point. I'm dragging it. I'm sorry. Something wrong with me, bro. I just like looking at numbers all day for some reason. So Tesla is spiked up in 2022, and then they start to drop back off. It's actually decreasing. So like this is decreasing free cash flow. So I kind of thought of Tesla, but I didn't know for sure. But Tesla is a debt-heavy business, so that's something to know. But the cash flow is dropping off, so that's just something to keep in mind. Usually, if you see negative, how you see this negative? If you see negative numbers in free cash flow, that's a bad position to be in. It's a bad position to be in. I ain't gonna lie to you. It's a bad position to be in. But it ain't the end of the world. They go turn it around. They got a plan, but that's ain't good. All right. Next thing. P/E ratio compares a company's stock price to its earnings per share. A high P might indicate overvaluation, while a low P could suggest undervaluation. All right. So remember how I was telling y'all earlier? We could look at Tesla actually now. P/E ratio. So the P/E ratio is the price to earnings. So what is the price compared to its earnings? So remember we're looking at the financial statements right quick. The financial statement is let's look for earnings, right? So earnings per share. So for every share we have, we're gonna make $4. So if we own one share, we're gonna make $4 per share we own. That's basically what that means, right? Compared to what we make as far as our earnings. So, let's see, is it operating expenses basically? So let's just look at the profit, right? So let's just say, for instance, the profit of the company, right? Our earnings is the profit, so it's after our revenue, after all our stuff. So we're earning $17 million. We're earning $17 million. So $17 million per share would be $4 per share. Well, divided by the share number, it'll be $4 per share. So that is basically what we're looking at, right? The basic earnings per share, right? As you can see, it has been increased, so it looked like it's been getting a little bit more overvalued, right? Oh my God, I did that wrong. I'm looking at earnings per share, not price to earnings. Jesus Christ. Oh my God. I'm looking at the wrong thing. Jesus Christ. But that's actually earnings per share is actually what I broke down the right way. So that's it's $4 earnings per share, right? But we go to statistics and this is price to earnings. So all right. This is the price comparison earnings. So as we can see, the forward P ratio is what we expect it to be in the next 12 months. The trailing P ratio is the past 12 months, right? So as we see, the forward price to earnings ratio has actually increased, which means that since it increased, we actually expect it to become more overvalued in the future, right? So if we expect it to become more overvalued, then we know that this is a company we might want to look twice before we end up buying, right? Because it was actually cheaper in the 12 in the it was actually cheaper in the last 12 months to buy Tesla than it is now to buy Tesla. Okay, so that's what that is. I'm sorry, I was looking at that the wrong way. I'm sorry. I apologize for that. Price to book ratio compares the stock price to the company's book value. A price to book ratio under one may indicate undervaluation. So if it's under one, one is basically is where it needs to be. Is at a set value, right? So this price to book is over when it's at $20. So it's $20 over the book value. So basically for everything in the company, the price is $20 over. So that'll be considered overvaluation. And Tesla is definitely overvalued right now. Between Elon Musk and Donald Trump and everything that's going on before this inauguration, right now this is January 18th. So yeah, this is insane. Tesla's insane right now. So that's overvalued. We can see in the future they also expect it to be overvalued. So if you want to start trimming your profits or whatever you want to do, this wouldn't be a bad time to do that. And dividend yield shows how much a company pays out in dividends relative to its stock price. A high yield may indicate a strong financial position, but be cautious of extremely high yields as they might not be sustainable. Now, an example of an extremely high yield is like Verizon. So Verizon last time I checked was like an 80% yield. So if okay, let's look at Verizon. I'm about to pick on Verizon now. Verizon actually is a company I think I want to pick on early, maybe. I know they might have free cash flow. I'm not sure, but whatever. Look at the financials, right? So, this is perfect. Okay. All right, gross profit. Verizon is $80 million in profit, so that's amazing. They're making, well, I guess what times 10 is 8. Whatever. It's just whatever. 80 million to the thousand, whatever. All right, so if that'd be 80 billion. 80. Jesus Christ, that's insane. That number is insane, bro. All right, Verizon make 80 billion this year so far, right? 80% of this, and we gotta look at that payout ratio to see what it is, but 80% of this would pretty much be about 60 million, something like that, 60, 70-ish million. So, not 70, about 60, something like that. So, all of their profits, 60 million of their profits is going back to shareholders to pay them in dividends, right? Because it's a dividend company. Its majority of dividends doesn't grow that much. So if all of our money is going to dividends, when do we have time or when do we have enough money to put into the company to actually grow it more? So that's why they say watch for high dividend companies. Now, as long as you feel like this company is steady, and we can look at the stock chart actually, we can look at Verizon, we can look at the daily chart. As you can see, remember I told y'all in the Nike example, when we was looking at Nike that day, it has been decreasing. So we went from $62 and it dropped all the way. So this would have been a good short now. Remember I told you about that 200, don't sleep on that 200 EMA. We dropped below. We would have had a winning trade here the way I like to trade. We popped up, another winning trade popped up, winning trade, and it dragged all the way down. Amazing swing. Popped up, dropped again. Came up, retested, dropped all the way down. And it held, so we would have held all this profit. This is all profit. Right? All profit. It's amazing. It's beautiful. This is a strong sell-off, right? Super strong sell-off. So we usually want to buy stocks if we believe they're good stocks above the 200, right? Now, you have a stock that you know that's guaranteed to go up because the powers that be will make sure that company ain't going nowhere. When they drop like right here, bro, you want to put your life savings into like if we're looking at Apple chart, and obviously none of this wouldn't have happened because Apple ain't know what Apple's doing unless we hit like a great recession or like a bear market. If Apple, look at Apple, right? And if Apple did this, Yeah, liquidate everything. Now it didn't even stay there though, right? Didn't stay there. It only wicked. It was a crazy wick. But if Apple did this, yeah, let me see what it was in one day. This was from here. It dropped 15% in one day and then bounced back up 50. Yeah, that's insane. Lifesavers right here. You would have made that much money in a day. Yeah, that's insane. So, depending on the company you choose, yeah. But like I said, Verizon is coming down all the time. So that's dividend yield. Just watch out for low dividend yield companies. And I like Tesla. I don't even think Tesla pays a dividend yield. So let's look at like the summary of Tesla. We'll pull up Tesla back up right quick. So the summary. Yeah, so Tesla doesn't even pay a dividend yet. So some companies don't pay a dividend yet, but Tesla for the dividend they focus on growth. So as you can see, in the last 5 years, they have 1,145% return. So you made an 11x on your money. So for instance, in Tesla, if you would have invested in Tesla 5 years ago and you put $1 million in, right now you would have 11 million. So 11 million in 5 years. Who do you what profession do you know that makes 11 million in 5 years, which is basically like 2.1 million a year, something like that. That's like two. That's like basically like 2.1 million a year. What profession do you know that makes 2.1 million a year out of college? Yeah, exactly. So, yeah, stop playing with me. All right, stop playing. All right, control. Let's get back into it. Assessing the company's industry and market position. Industry trends. Research the broader industry or sector to understand growth prospects, competition, and risk. A strong industry can drive company growth, while a struggling industry can limit potential returns, right? So, for instance, if we're in a strong industry like technology, right? Technology is the future right now. Technology is the future. We got things like crypto, we got things like smart glasses, we got things like everything going on. Self-driving cars. That's a strong industry, right? So that industry is doing real good right now. Everything technology is doing good. So that would be a stronger energy than say, um, depending on the industry company. But overall, like energy, for example, like we know that we're starting to get out of oil and we're starting to get into technology. So, for instance, investing into like an oil company, if we know that eventually oil will go will go extinct. Eventually, the prices of oil will go up, which means the company start to make more money. But then eventually, when you run out of oil, you no longer have a product to sell. So that means eventually that company will become super weak and we're relying on oil. Now the energy company as a whole, we're talking about solar energy and different energy things, and that's different. So all of the companies, if you're not within that actual niche of that industry, then you will be within the weak side of that. But the company advantage is a moat. So Apple has a moat. Like a moat would be like for any app that has to get on the app store, they have to pay a 30% charge. So a lot of y'all don't know, but like Apple charges 30% on whatever. So if a company charges $1, if you pay $1 to like for an app on the app store, that company actually had to pay 30 cents on that dollar. So a lot of people don't know that. That's a moat. That's like, but Apple is the best company. So we just not going to put your app on the app store, or you're going to pay that fine. Apple like the mafia, so that's a moat. Moat is what competitive advantage do you have that no matter what you have to live up to. That's a moat, right? It's a super duper competitive advantage. Proprietary technology, brand loyalty is another one. They be like, you got that green bubble or do you got that blue bubble? If you got that blue bubble, then you with us. But so everybody want the blue bubble, so everybody want the iPhone. And cost advantages that protect it from competitors. Valuation and making investment decisions. After analyzing financial statements and key ratios, compare the company intrinsic value to its current market price to determine if it's overvalued, undervalued, or fairly priced. Intrinsic value can be calculated through measures like discounted cash flow, which estimates the present value of future cash flow. If a stock market price is below its intrinsic value, it may be considered a good buy, and vice versa. Always consider the company's growth potential, market conditions, and economic factors before making a final decision. The company's growth potential, does it have future growth? Do you see it around and being more dominant in the next 20 years? That's growth potential. Market conditions, are we in a bull market or the bear market? If we are in a bear market, we should start to wait for the bear market to consolidate or bottom out before we consider buying. Or we just put in predetermined price targets where it has bounced before or where it could likely bounce. And economic factors, are we at war right now? Is Trump about to be in office, etc. A lot of economic factors like that as well. All right, and that is it. That is it. Appreciate y'all for tuning in. See y'all in day